I'm going to talk about contrarian investing. Almost everything Catherine does, I do the opposite of. She buys good stocks, I buy bad stocks. She's global, I go round parts of the UK. But the great thing about the investment trust sector is there are lots of different ways to skin that proverbial cat, and they all work well. And if they're carried out well with real keen attention to detail, they can all work. So I have huge admiration for Baillie Gifford and Catherine and her team at Scottish Mortgage, but I do it differently. And the great thing about the sector is there is choice. There are different ways of doing it. So my first chart, I didn't know Catherine was going to talk about it, but Catherine's stocks are lovely. They go up. It's really, really nice. I buy dull stocks, and they often go down. But I have run Lowland, which the trust I was talking about, but I'm actually going to talk about Lord Adventure. I see a Lord Adventure director in the room, and I love all my children equally. I love all my trusts, and I'm just reassuring the director in the room. But I have run Lowland for 26 years, and £100 then. Of course, you would have needed to invest, you would have needed to buy shares with the dividend every time, and you would always be the person that was managed to buy the shares the dividend came, but that's how we show statistics. You'd have £2,200. If you'd done the same in the index, you'd have £700. So the contrarian value guy, there is money to be made looking at those dull problems. And why it works is because we pay attention to it. I just don't know if Illumina is the star of the future. Catherine has got insights and knows. To me, it's too difficult. There are too many clever people telling you where the internet's going. How can I know? What I try and do is I try and pay attention to smaller companies often. I do large, medium and small, but try and pay attention to things people aren't paying attention to. If I know something, I try and see an angle because no one else is bothered with it. Then I've got a bit of a chance. I always had a good friend who was a successful gambler who's probably, luckily he doesn't, I hope for you, Simon, he doesn't use Ladbrokes too often because he is a very good gambler. On the day of the Epsom Derby, he will be at Newcastle races. Everyone is trying to work out who's going to win the Derby. Everyone's concentrating on that. Therefore, you get the value bet. You can back a horse at 5-1 that should be 5-2 at Newcastle that day, and you can make money. You've got to pay attention to things other people aren't paying attention to, and then you've got your opportunity. So everyone hates these stocks. Look at them. So that's your opportunity. Pay attention down there, and you can add value over time. And you also are playing with a little bit less risk. Catherine was completely open. The approach. There will be huge winners and losers in that area, and there will be actually more losers than winners in the world of tech, but the winners will be great winners, and with her portfolio, they've shown how they can do that. But actually, down here, expectations are lower, and things sometimes when they're on the floor don't fall through the floorboards. So, before I get on to stocks, I'll just go into the swings of emotion. People love to be associated with success. Companies and analysts are emotional people. They get it wrong. They start, when things go wrong, they start to whack down profit estimates, and when things start to go right, they whack them up. They react too much each way. And one of the things about life is it's rarely as good as you're told, but it's also rarely as bad as you're told. And the emotional swings of the market are over-exaggerated. So what I'm trying to do is trying to take a bit of emotion out. And when people tell you, God, it's awful, ooh, that might be interesting. And in a big dealing floor at Henderson's, you can always get that. My best manager I ever saw at Henderson's was a chap called Michael Moole. And I used to watch him. He used to always avoid the guy that had the smiley face that was at the top of the league table at the time. And he would always be talking to the guy that was looking particularly hard hit and feeling miserable. And he'd go to him for his ideas, because the guy that's smiling at the top of the table, you could absolutely be certain won't stay there forever. And the guy that sticks with his disciplines and is out of fashion he'll be the guy that recovers. So it was a good lesson to me watching him. Oh dear. Oh, we just talk about a couple of shares where these kind of swings of emotion of analysts getting overexcited then underexcited, getting overly worried and then the other way. Something like Bellway, it is a good house builder. We need more houses in the UK. They get upgrades, and everyone gets very excited. Interest rates, financial crisis, whoosh down. What you need in the investment trust structure is to be able to play some of that. And you need, and I've got the director in the room, so this is where the advert is, where you need a understanding board. Because I bought for Lord Debenture, as a Lord Debenture director, also for Lowland, some Bellway about here, and then I bought some more here, and I turned up to the board meeting here. And you need a patient board. They need to. I was buying it below book. I started to buy it below book at about £7. It fell to £3. Fell to £5. I bought some more. I think I lost my bottle down here probably. But the fact was, I was buying and averaging all the way down. It recovers. It's nice, but then when it gets to more than twice book, and people tell you house prices are only going one way, well, then thank you very much. Don't disagree with them. Smile sweetly and start to sell the shares. So I put this red rose slide in. There's one other. The best bit of advice I ever got from a managing director at Henderson's was, it was in a period when the market was very difficult. It was I remember the year. It was 1992, and I'd been running Lowland for 2 or 3 years at the time, and we were down the tables, and I was going to present to people, and they were immediately selling the shares, and I was, I wasn't popular. It was in the housing. It was a housing crisis back then in '92, actually, and I was buying the house builders then, and I was buying manufacturing then, and people were saying UK was working away from being an industrial country anymore. And it was difficult, but my value presentations weren't going down well, and went to discount was opening up, and some of the board were feeling a bit uneasy. So I went to him and asked him for advice. He said, "Forget everything, James. Just forget everything. Go out, find those companies that appear cheap, and buy some. Forget everything. Don't worry about your presentation. Don't worry about your investment process that you're trying to articulate, and just focus on one thing. Buy a few shares before they go up." And I've always had that as my driver. And why do I say that? Well, this Stephen Morgan, the boss of Redrow, when he left the company he'd founded it, left it, financial crisis, company fell a long way. Again, I was buying, feeling the pain. Like Catherine says, you need to feel lonely in life. You do need to feel lonely in investment. You're absolutely right. Feeling the pain. The interesting thing was, though, it was starting to recover. At about here, Stephen Morgan himself decided he was going to buy the whole company, and occasionally have real rows in life. He said, the price I remember was £1.20 at the time, just recovering, and he said, "I'm really generous. I'm going to be really kind to you investors. I'm going to buy it at £1.60. You must be absolutely thrilled, aren't you, James?" And I told him, my language was fairly polite, but it was a recorded line, and I wouldn't want to play back the recording actually. And I said, "No, it can't be less than," and said, "Well, what price?" And I said, "No, it's got to be substantially higher." And I said, "Okay, you tell me what you go to." He said, "I can't go over 220. I said, "Absolutely not." And he told us how stupid we were, etc., etc. But why I say that is, then when that all came out and was out, I bought quite a lot more shares, because if someone like Stephen Morgan, he's got real insights into house building, and is very good at it, why be clever? You know, just buy some shares, follow him, and it's been worthwhile. So the focus is paying attention, trying to make money, not having any big preconceived ideas about your matrix of valuation. Occasionally you just pay attention and you can do it. So another area that's been great, the house builders have been good. They've been fun. You just have to pay attention. You have to be prepared to leave the party. And I've actually sold all my house builders now, and I'll be wrong for a bit, I know, but it is a cyclical industry, and you can move on. There are always other things to do. This actually is now about the largest holding in Lowland. Why I put it in it's to try and explain why I think recovery investing, contrarian investing works. Back in '92, Lloyd's virtually went bust. Lloyd's Assurance of London, virtually bust. They had reconstruction and renewal. They'd had asbestos bringing the whole institution down. But in that time, there was they had to move away from being funded by the names, by private individuals, to bring in corporate capital. And it wasn't clear that there was really any business there at all at Lloyd's. But I was told that there were some really genuine underwriters that could add real value. But for all the noise, it wasn't clear that there was. But what happened at Lloyd's was they focused at that time. They looked at themselves. They got rid of a lot of people. They thought, where do we add value? What lines of business are we good at? And they stuck with them, and they became disciplined. They turned business away that wasn't right, and they came back to doing what they did best. And Lloyd's and Hiscox had some of those best underwriters, and it has been, the disciplines are still there. They keep giving us capital back because they can't find enough good risk to write, keep giving capital back in dividends. So this is just the share price. Actually, there's been very good distributions as well. It has been a great investment, but those still the same disciplines. And when they looked over the abyss of thinking they had no business at all, that Lloyd's was going to close, that gave them the discipline and the understanding of their business that has lasted them through. That's what happens in recovery investment. When people really have got their back to the wall, they learn they relearn what they're good at, and they either sink or swim, and they got to remember it. They can't forget it. So when do you buy a recovery share? I think what happened to me on this share was when they looked at themselves and decided back end of last year that they weren't any good at iron ore, Anglos. They weren't any good at coal. They decided what they were good at, and look around, diamonds. You know, De Beers is a great business. Anglos own 80% of De Beers. Is a great business. They were going to focus on De Beers. They were going to focus on copper. They were going to just get rid of all the rest of the noise. And that has so far been right to buy. It's recovered a bit too quickly, perhaps, and a bit too lucky, so you've got to be prepared to take profits on the way. But it is one of those shares that would be driving that initial chart down. What the hell are you doing in it? Well, paying attention and asking yourself, has the company returned to what it did best? Did it give up all its grandiose ideas of being a great, huge global miner to doing what it does best, diamonds? And, you know, diamonds are a girl's best friend. They don't disappear. And actually, demand for diamonds is already picking up and pricing is picking up. So that is back in, that's in the portfolio. Bit of profit taking of late. But of course, people like me, you know, we're used to failure. You know, failure is what it's all about. Not everything recovers. Things often get very cheap before they go bust. And that's what Peabody Coal has now done. It's gone into Chapter 11, luckily not in the portfolio. But I put it there just because you can't just buy indiscriminately recovery stories. You know, you'd have felt quite clever here on Peabody. But you've got to ask, is there a real reason for the company? Is the raise in debt for the company going to be reborn? Are they going to reinvent themselves? And the trouble with Peabody is there was too much debt, and coal is going to remain very difficult. It's not like diamonds. And that's what's happened to poor old Peabody. Where's the opportunities in this market? I get into trouble when I present often. I say, I like buying high Ps. I thought you meant to be a value guy that buys cheap things. Well, things do look very expensive in straight PE terms when they're very cheap, because their profits have disappeared. It's that the profits are going to rebound very sharply, so it's going to go boom over the next 3 years, the mining sector. So not just Ps, you've got to look at other valuations as Simon metrics, as Simon was talking about. So you can buy some of the big miners on half book or less than that. The other things there, insurance is again, I don't really look at the PE. We're looking at returns on capital achieved, returns on assets in the business, and there are some good opportunities in the insurance sector still. I stick with those Hiscox and things. But for me, the real opportunity in the market is having a broad spread. You can find opportunities across the market. And the great thing about the investments trust structure, I have about a third in each of those sections, that small cap is a real opportunity. A lot of people are dismissing the small end of small companies. But with a closed-end structure, I'm not going to have any money taken off me at Lowland, unless I lose my job. But I'm not going to have money taken off me, so I can focus on buying some of these opportunities down here. It's easier to make money down here if you're paying attention. There aren't the clever people looking at them, as in the tech sector. These are the forgotten companies, and if they're sort of forgotten, you've got an opportunity. And when you go and visit, and they say, "Oh Christ, no one's come to visit us for 4 years, James." That's a really good. That's a really good sign, because you're on the floor. Then you only need 2 or 3 people to come and visit it, and you've got demand, and the share can go up. And that's what's happening down at the bottom end of the smaller companies. People are saying, "I'm not looking at anything below 150 million." Well, what's so remarkable about 150 million? I don't know. If the thing is £20 million company and it become a £200 million company, it's much, much more likely to do that than be a £200 million company and go to a £2 billion company. So, but to do that, you need to be running a long list. I have 2 minutes. Need spread. You need large, medium, and small companies. Scarpa makes industrial tape just outside Marlborough. Royal Dutch Shell does what it does, and Hiscox, I've talked about it. The other area that's important is industrials. There are some wonderful industrial companies left in the UK. The ones that have succeeded and grown in recent years are excellent businesses with truly competitive product. A lot of manufacturing has left the UK. The ones that are left are truly competitive, and there are some real opportunities in companies like Scarpa, Senior, GK, and Hill & Smith. Unconstrained, cross the market cap, don't overly worry about size. This is a closed-end structure. Need long lists. I know about failure. That same director who told me, just bloody well focus and buy a few stocks before they go up, James, stop worrying. Also once I went to him and said, nothing's gone bust in the last year. And he just told me, James, you're not trying hard enough. You're not taking enough risk. You need to run a long list of that approach, and I do have 126 stocks, and some will go. But if you're not taking enough, it's like playing tennis. If you never serve a double fault, you're not trying to hit your second serve hard enough. I know things will go wrong. I'm used to dealing with failure, and it's in failure before they relearn those disciplines, before they is where the best investments for me are made. This is just one investment approach. As I said at the start, lots of different investment approaches work, but you just have to choose one that suits your character, suits how you see the world. I find it easier dealing with people who are having a difficult time than those wonderful people that Catherine put on her slide. Apart from they wouldn't talk to me, but they talk to Catherine. But the people that I talk to are very keen to talk to someone because no one else is talking to them, and it is a way that works. And I hope that with investment trusts, as AJ Bell have allowed us today, there is great variety with people doing different things in different ways. We will grow our dividend, and it's grown 9% last year. It's growing at about 10% at the moment, from that lower level than Simon, by growing the capital, by buying companies that are out of favour, that are coming back into favour. And that's my approach. Thank you very much.